Welcome back to Money Matters. I'm Emily Johnson, joined as always by David Kroll, and we have been discussing mostly economics and where the economy has been, and where we anticipate through people that know a lot more than we do, because they're out there, expect that it's going. So we actually, just off camera, we're discussing what the Mortgage Bankers Association is sort of looking at on the 10-year Treasury, and we wanted to sort of lead off with that.
This is, I gave you a couple of little bits of data that at the lowest, the 10-year Treasury reached 1.36%. At the highest, 2.6% this April 8th. It's down to 2.3 right now. The Mortgage Bankers Association has a over 50% consensus amongst its economists that the 10-year will go back below 2. Now, not much, but that it will dip below 2%. That's huge news, and it raises a big conversation between people like us as to why, what might be pushing it there, what's structurally in the world economy and the national economy, what structurally is going to make that so. Here's a couple of leads to that. First, what's the local consequence if that happens? Rates have already gone from 4.25% to 3.99%. That would push them the additional quarter to 3/8% back to 3.6, 3.7. This is for a perfect, high-quality 30-year fixed-rate mortgage. These are extraordinarily low rates. These are rates that are 50, 60, 70-year lows.
Right.
And it makes asset ownership, home ownership, really a good deal.
You take that to the next level, and I know we have lots of different aspects of this. We take that to the next level of corporations and businesses. That means their cost of capital is also very, very low. And there's been a concern in the broad equity market that if we did see a jump up in interest rates, that we would see a revaluation of stocks, of equities, of companies, because their cost of capital is going to be going up. And cost to borrow is going up. But if we're seeing rates staying this low and maybe even going down, that should, in theory, assuming that all these other things stay static, that should mean that the market would continue to either go sideways or potentially still move up, because we had the expectation there'd be a revaluation. We had the expectation that we could see things become more volatile and start to trend downwards with higher interest rates. If those higher interest rates aren't there, market then stabilizes again. So
exactly, and then you've got contraindicators. The bank stocks this week have gone down. Overall lending has gone down. This is in the Citicorps and the Bank of Americas. I mean, the really big.
Two big factors. One of those, of course, because of the spread. There's just not a spread, so there's no risk-reward relationship to lending. But then the other is the growth factor that you talked about
That's the growth
at the beginning
factor.
of the show. There's just not a whole lot of growth. So if there's not growth and you're not getting rewarded for lending money, you ain't doing it.
Then you don't do it, and you find other places to put the money. If you're Jamie Dimon at the head of the biggest of banks, then you find other places to put the money where you can, and you give it to your traders, and you basically play the stock market with the bank's money instead of lending it into the economy, not because you're reluctant to lend, but because nobody's asking you, nobody's pressuring you. So there's an adverse market spiral. You can't charge enough to make it interesting, and the reason you can't charge enough is that there's not enough demand to make it interesting.
Well,
it's very interesting.
It is, and then also one thing that you notice if you're in our area, just in and around Hilton Head, lots and lots of renovation, new builds, that type of thing. So just like we talked about 6 years ago, 5 years ago, 4 years ago, when the markets were really bumping up, if you had money in the markets, and if you had purchased a home when the markets were in a handbasket, then you were benefiting from this drive up in the stock market, the drive up back up in real estate. If you did not, then you don't participate at all. So we're sort of seeing the exact same thing now. Keeping rates really low is great if you have, number one, the ability to borrow and the desire to borrow and the opportunity to borrow, whether it's for a house or for business or whatever. It's going to be beneficial for that sector, that class. it's not going to do anything for those that don't necessarily have that opportunity, and it's harmful for those that are actually on the savings side of things if they're looking for some sort of safety and savings, either one because they can't afford to take the risk, or number two because they just can't stomach the risk that comes with it. So,
Right.
so these types of rates, they really do harm the saving public.
Which
And-
is people in their late 60s, 70s, and 80s who have modest wealth and who are trying to arrange a last 20 years of their lives, last 15 years of their lives in some kind of orderly fashion. They're looking to safe investments in which they can earn a return, and there's no return to be
Well,
made.
and yeah, and from my perspective, when we're looking at putting together financial plans for these families and individuals, the historic assumptions are all off. So you have to go back in and change all of your assumptions moving forward. Like, number one, what's inflation going to be? Is it like current inflation, or is it going to be historic inflation? If you want to be conservative, you have to go back to sort of higher inflationary rates, because the stuff that you actually use, healthcare, food, these things, they actually are inflating.
They actually are inflating.
Yeah, but if you
That's
listen
right.
to real
Right.
numbers, they say, oh, inflation's 1%. No, it's not. Inflation, as we assume it, is actually closer to probably 4%, because your healthcare is probably inflating at 6 to 10%. So, that's one
That's
thing you have
very
to look at.
interesting.
It
Very
is. And
interesting,
then the other is, historically, if you're looking at, and this, I get this all the time, clients will come in and they'll say, why is my mutual fund only generating 2.3% when it's a such and such type fund? Well, that's sort of the market rate right now for that type of a total return, or that type of a an income-based, balanced income-based fund. So having to rejigger that, and how we can actually generate slightly higher interest without taking a whole lot more risk is really challenging. But if you're looking historically at where you want them to be, or where they were when your parents were there, it is just not there. And
It's not there. No.
It's
And-
completely different
and-
calculation.
And then when you go, same conversation, exact same conversation, when you go to the people who benefit from the lower rates in this area, and for anybody listening, identify immediately the first-time home buyers, second-time home buyers in your family or in your network. They should be in the market right now. The builders, the D.R. Hortons, the Village Park Homes, the Hovnanians, they're all doing superb jobs at delivering a substantial product at a relatively low price. They've gotten very, very, very competitive. When you throw a low interest rate on that, you've got a 2,300 square foot home or 2,200 square foot home for significantly less than you can rent.
Oh, without question.
Significantly less. This is the time that you need to be in the market, because the market, a low interest rate market like this, runs advantageously for you. So it's a super interesting phenomenon. What we're beginning to see as a company, a Mortgage Network is in 30 locations, Maine to Florida. What we're seeing as a company is that there's a tremendous drive of first-time, second-time, third-time borrowers in the 25-year-old to 45-year-old bracket. So I guess that would be millennials and what is it? The Y.
Oh, more the Gen X, Gen Y.
Gen X,
so
Gen
let's see.
Y, and
I'm almost
millennials.
40, so that puts me, I think, somewhere between X and Y, and then millennials, I think, are in the high 20s.
That's correct.
Yeah,
So that whole group are in the market buying. However, what's coming down the coastline from Massachusetts, where one of our offices had a client last week who put in an offer on a house and did not get it because there were 40 other offers, 40 other officers. So those offices in Massachusetts, we have 8 offices in Massachusetts, are finding that the inventory is so incredibly tight that their borrowers can't find houses.
And that's happening here as well.
And
I mean,
then
finally, our inventory has tightened up quite a bit.
And then you come down to our office in Charleston and Mount Pleasant, and the inventory there is incredibly tight. And that's starting to be the case here. So that means prices are probably going to go up a bit. Yeah.
That's what we've been waiting for a while. So,
Yeah.
all right. Well, thank you very much for checking out our show today. Please send us your thoughts, questions, concerns. We love hearing from you. We love case studies. We love answering questions on the air. So anything that you want to throw our way, please do so. Check us out on Facebook. And until next week, this has been Money Matters. Happy Heritage and Happy Easter.